In my opinion, there's never been a better time to be a high-yield dividend investor. I've noticed over the last 3.5 years that there's been a lot of companies launching new high-yielding ETF products to meet the demands of investors. And I think it first started with some of these newer companies like Global X who were creating these new ETFs that were using covered call strategies to a certain degree. Now even large financial institutions like Blackrock and JP Morgan have been jumping on the bandwagon in the last couple years by offering high-yielding funds that offer yields exceeding 10% in some cases. It shows that more people are becoming attracted to this style of investing, which I've been a big fan of for many years. In this video, we're going to take a look at another brand new fund that was just launched that offers an extremely high yield, which is the Kraneshares China Internet and Covered Call Strategy ETF, ticker symbol KLIP. This ETF seeks to provide current income through buying Kraneshares CSI China Internet ETF, ticker KWEB, and selling covered calls on it. KWEB consists of China-based companies whose primary business is focused on internet and internet-related technologies. The fund holds publicly traded securities on either the Hong Kong Stock Exchange, the NASDAQ, or the New York Stock Exchange. KWEB seeks to provide exposure to companies benefiting from the increasing domestic consumption by China's growing middle class. According to KLIP's website, this ETF currently offers investors an insane 57.35% dividend yield, and it also pays dividends on a monthly basis. It's for this reason I've gotten a lot of requests to review this ETF because it offers a very similar yield to the Yield Max ETFs that we've looked at like TSLY and NVDY. It's a brand new fund that was just launched earlier this year, so it's still relatively undiscovered by most. At 57.35%, this is currently one of the highest yielding ETFs available to investors. So for those of us who really love these high yielding investments, let's take a deeper look into KLIP and see if this is a good monthly income fund worthy of consideration for our portfolios. The first thing that stood out to me in this fund's description is that this ETF apparently only holds one holding inside of it. Looking at Kraneshares' website, we can see that it does in fact only hold the Kraneshares CSI Internet ETF. The rest of this stuff here is either cash or the call options that it writes on it. So for the first part of this video, we're going to spend a lot of time looking at KWEB. This ETF exclusively holds Chinese internet and e-commerce companies. As of the making of this video, you can see this fund holds 31 different companies and their top 5 holdings make up roughly 41% of this fund's portfolio. You can also see this fund does hold some recognizable companies. For example, most people have probably heard of Alibaba. You might also be familiar with companies like JD, Tencent, and Baidu, which this ETF also holds. But some of this stuff I've never heard of, like Bilibili, which I guess is a Chinese video sharing site, or KE Holdings, which is a company that offers a platform for housing transactions. This can lead to a problem, which is that some of these companies can be harder to analyze. For stocks that trade on the New York Stock Exchange or the NASDAQ, they're required to submit to guidelines to make sure that they all report the same financials. I'm not familiar at all with the Hong Kong stock markets, but looking at some of their stocks, they seem to report financials in a very similar fashion. Another concern to keep in mind is political risk. When you invest in companies located outside of your country, it helps to know the political and economic landscape of the country of the stock you're invested in. If you're not interested in doing the homework, which is understandable because this would be a lot, you need to have a lot of confidence that the fund managers are well versed in the landscape the companies are located in. It looks like the head portfolio manager for this ETF worked in the ETF Global Capital Markets group at State Street for 9 years. How much of that time was spent specifically on Chinese companies, I have no idea. But ultimately, what really matters is performance. If we look at the long-term trend of KWEB, we can see it spent a good amount of time growing for the first few years of its existence, but then in 2017, its share price saw a good amount of growth before falling again, and then in 2020, there was a huge uptick before it fell again. Since early 2022, the share price of KWEB has basically flatlined, although for 2023, it's currently down 13.5% for the year. It's also down 40% from this time 5 years ago, and it's down 5% from this time 10 years ago. Looking at this chart, I think it shows that KWEB isn't an ideal long-term buy and hold kind of investment. It's apparent in my opinion that there are periods when it makes sense to buy this ETF, and there's periods when it should be sold. But what about KLIP? This ETF is able to pay its ultra-high distributions by writing covered call options on KWEB and passing the premiums on to shareholders in the form of dividends. The good thing about these kinds of high-yielding funds is that when the underlying stock or ETF is flatlining or even moderately going down, they can still offer really good returns through writing covered call options. Unfortunately, KLIP launched during a bad time as we've seen Chinese internet companies have been experiencing a downturn. Since KLIP's IPO in January, its share price has fallen by more than 28%, which makes this ETF look like a terrible investment. But the crazy thing is, because of its insane dividend yield, even though the share price has fallen by a huge amount, it's still been a profitable investment. And that's regardless if you chose to reinvest your dividends or not. Using our drip calculator, we can see a $10,000 investment into KLIP on the day this ETF launched, you'd be looking at a total return of 6.84%. Remember, that's only after 8 months. This fund has only been around for a short amount of time. Right now, you'd be looking at a total profit of $684 on your original investment. You can also see that the majority of the time it's been in the red. But as the months go on and the dividends keep compounding through reinvesting, it's still been going upward. If the market continues to perform as it has been, our DRIP calculator estimates that it'll provide an annualized return of 10.5%, which beats the S&P 500 during an average year. I think that's pretty crazy to think about. How could a fund that's lost so much of its share price still potentially beat the market? It's all because of the massive dividends it provides through selling call options. Even if we didn't reinvest and let the dividend snowball, it would still provide a positive return of 4.47%. Not as great, obviously, but still an impressive amount in my opinion considering the share price. Let's look at the dividend distributions for this fund. It's currently only declared 8 monthly dividends so far, but we can already see a pattern. Just like the share price performance of KLIP falling, the amount of monthly dividends have also been going down. One of the driving factors as to how much in dividends this ETF pays has to do with volatility. On Kraneshares' website, it says writing covered calls may produce higher yields during periods of market volatility. It also goes on to say that KWEB provides exposure to the China internet sector, which has historically been more volatile than the US internet/technology sector. I actually decided to compare KLIP's performance to KWEB's performance side by side, and currently KLIP is destroying the underlying security that it's actually writing covered call options on. There's such a huge difference, it's pretty remarkable, and this is what can make these covered call funds so appealing during sideways markets. But in the case of this ETF, I'm seeing a lot of similarities to other covered call funds like TSLY. When the share price of the underlying security, which in this case is Tesla, goes up, then the dividends go up. But when the share price of Tesla falls, then the share price of the covered call fund and the dividend distributions also fall. Given how KLIP works, what's going on with TSLY will probably happen with this ETF as well. A downside to these funds is that when the underlying security falls, then the covered call fund will also fall, but when the share price of the underlying security rises, then the share price of the covered call fund will only rise to a certain amount. That's because given the nature of how these funds work, there's a cap that they experience given the fact that they write call options. KLIP will only experience so much upside in share price growth, but it'll experience the exact same amount of share price declines as the security it's writing options on, which in this case is KWEB. To summarize, I think it's clear that KLIP does have good things and bad things to it. We've already seen that when you reinvest the dividends that this ETF pays, it can actually be a very profitable investment. This is also true for some other high-yielding funds with some insanely high yields. If you reinvest the dividends, even if it's lost over 90% of its value since its IPO, it can still be a profitable investment. When it comes to covered call funds, I always prefer the ones that write call options on indexes and not just a single individual stock. Indexes hold hundreds or even thousands of securities, which helps for diversification, which is what KWEB holds. Honestly, when I first came across this fund, I thought it was a pretty strange idea for an ETF. While I am glad that we have another option available for high-yield investors, I think it's strange to offer a covered call fund that focuses specifically on Chinese internet companies. Out of all the indexes and ETFs that exist, I'm not entirely sure why they decided to create a covered call fund specifically for this one. Given how little I know about the Chinese economy, I'm not currently a shareholder of this ETF, and I think it is a much riskier holding by nature. So do your own research and come to your own conclusion before making any investment decision for yourself. But with that being said, that's going to wrap up today's video and our look at KLIP. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.